Hi everyone, thank you for joining us this morning. For those of you who don't remember from our last webinar, my name is Lucy Stagg. I'm a Senior Manager in our Commercial Department in Atradius, and I'm here today with Chris and Nicola, and we are going to talk everything engineering and transport today. So can I open the floor to you, Nick, to introduce yourself?
Yeah, absolutely. Good morning, everybody. My name's Nicola Harris. I'm one of the senior underwriters for Atradius UK, responsible for the transport and metals book, and I've been with Atradius for the past 7 years.
Chris?
Good morning, everyone. As Lucy said, my name is Chris Wall. I'm a senior underwriter with Atradius, same as Nicola, and this is my 20th year with Atradius. In September,
Just a few under your belt then.
Yes, done many sectors within those years as well.
Fabulous. So, engineering and transport, I think it's fair to say there's a lot of challenges going on in the environment, regardless of sector at the moment. So, to try and kind of start navigating some of those challenges, maybe, Chris, if I can throw a question to you, can you kind of give us an update on what's going on with oil prices at the moment?
Yeah, sure, Lucy. I mean, tracking the oil price is perhaps one of the greatest barometers of economic performance that we have, really. Naturally, when the oil price is high, we can make the assumption that economies are generating GDP and therefore consuming greater degree of oil. We saw a real tail-off in prices come the pandemic, when obviously the world closed and the demand for oil, dried up. Since the pandemic, though, and as the world economy and indeed the UK economy has reopened, we've seen a gradual and steady rise in the price of oil. And at the start of 2022, it really had peaked to a point where it was quite worrying. And we saw a lot of press regarding the sort of profits that oil companies were making and calling for windfall taxes to help out with the economic hardships we faced in the UK. Now, in the last couple of months, we have seen a cooling off of that price. And, it's tracked back now to where we would expect it to be. So we are now back at, anywhere between $60 and $80 for a barrel of Brent crude oil. It is roughly where we want to be and where we'd expect it to be. That said, that is not taking into account any actions that maybe OPEC or some geopolitical factor may have on the oil price. It's stabilized a bit, and hopefully now that will give us a period of some stability. It is a big cost for many businesses because it feeds into nearly, all facets of industry. And if you can't pass that volatility on easily, then it does erode margin very, very easily and quickly.
Really interesting. Thank you for that. I mean, Nicola, this has got to have some sort of knock-on effect and on haulage, aviation, that sort of thing. Can you give a little bit of flavour in that side for us, please?
Yeah, absolutely. I think, like you said, it goes without saying, in terms of transport as a sector, very heavily dependent on the movements that we're seeing in the oil price that Chris has covered there. If we look at probably the two most prominent fuel users within the transport sector, hauliers at the moment suffered particularly over the last year, primarily because of the prices that we were seeing for diesel coming through. Chris has talked about some of the crude price movements there. We talk about the prices that were being paid at the pump. Diesel prices were up around the £2 per litre mark at the peak of last year compared to...
We all know it.
Absolutely. But when you compare that to about £1.28 pre-pandemic, that's a very significant move in a very short period of time. And even at today's prices, we're still very much ahead of the 10-year average. So they've remained at that high level. For hauliers, of course, it's only one of many price risks that they're facing or they've had to consume over the past year. There's a lot of other pressures coming from all angles, but this has certainly added to those pressures over the past 12 months. Most thankfully have fuel escalators built into their pricing models, but even still, when you're passing through that rising cost onto your customers, these businesses still have to take the immediate short-term hit of that, both in terms of their profits and their cash flow. So we are seeing that pinch push through on the haulage side. Aerospace is, I suppose, the other big player when it comes to fuel prices within my portfolio of transport. Slightly different metrics that we use for the aerospace sector. And I think we do have a slide we can share with you on that, just to paint the profile of what's happened to jet fuel prices over the past few months and years. Certainly last year, you can see that the crack spread, which is the difference between the Brent crude Chris has covered already and the jet fuel price itself, it peaked to $60 a barrel, and that's just the gap on top of crude pricing. So significant pressures last year for that sector, which is very prevalent when you think that of an airline's operating costs, fuel accounts for about a third of that. So very significant pressures for that industry as a whole. Similar to the escalators that we talked about in haulage, a lot of airlines have that hedged or partially hedged. But unfortunately, because in the peaks of last year, they were coming off the back of the pandemic travel restrictions, hedges were typically much lower than they had been for the against historic levels, which meant that a lot of those airlines have had to swallow the majority of those cost increases themselves. Thankfully, because of the recovery that we're seeing in the airline sector, by and large, particularly when it comes to passenger air travel, there's so much demand out there, and there has been since summer of last year, that we've been able to push those prices through into ticket pricing. We've seen them recover a lot of those cost increases through the pricing models that the industry is implementing.
Not all doom and gloom then.
Not at all. Certainly an extra challenge for them.
So we've got oil prices have been high. I mean, you touched on then, Nicola, that there are other input costs that are high. Maybe if I can throw this over to you, Chris, have we seen any particular hikes through the supply chain that's really causing challenges for businesses?
Yeah, I mean, I think it's important to say, Lucy, that no one supply chain has been immune from the challenges that we've seen, and not just within the UK. The inflationary pressures we've seen have been a global issue, and that's been predicated by a number of issues that we've faced in the global headwinds. But raw material inflation has been a constant challenge for a number of businesses now for several years, particularly exacerbated by the war in Ukraine, which has underpinned and driven high inflation prices, particularly within food and agri, because if you've got anything that relies on wheat, then that's been a particular, or grain indeed, has been a particular issue. And the oil prices I touched upon earlier, it feeds into so many other facets of the supply chain that it does have a detrimental effect when there is volatility. What I would say is, and while we don't look back too often, the pandemic did allow a degree of stress testing for many supply chains. So in a perverse sort of way, when the pandemic put pressures on supply chains, businesses and business owners were able to actually look at the weaknesses within their supply chain, and root out maybe mitigating strategies. What we've seen here is pure inflation in the price. And if you're unable to pass that on, that has led to margin erosion, cash burn, and as Nicola's touched on, there are sometimes escalators in place or contract price adjustment clauses that the customers can use, but it's difficult sometimes, and if I look at it, from my sector point of view, I underwrite the paper sector as well as the engineering sector. The paper sector has seen a tremendous increase in paper prices over the last 18 months, and that's been exacerbated by a number of factors. One of which is the real issue now that a lot of buyers are facing, is sanctions on Russia and Belarus, where, getting timber from those markets, sourcing product from them is uneconomically viable because of those sanctions. So there is a real concern there that will fuel further price inflation again, although of late we've seen a little bit of a cooling off. But it is interesting that over the last 18 months, we have dealt with inflation and the inflationary pressures within a supply chain. But, so recently now, a survey of business directors has highlighted that, okay, we've had inflation. There's several reports in the press that inflation is easing, and there's various metrics you can use to measure that, depending on the sector you're in. Food inflation remains the biggest one. But, a lot of directors out there now are actually really concerned about consumer confidence and a lack of consumer confidence. And that filtering through is more of an issue now than perhaps inflationary pressures are. That was indicated by a research done not so long ago by the Business Insights and consultancy surveys, where they said, look, vast amount of directors now running businesses are more concerned about the impact interest rates is having on consumer confidence, and this need and requirement to get inflation and grapple it under control, and what that could mean going forward.
I mean, it's really interesting, isn't it? Because those Bank of England base rates that drive everything, they're for a reason. We're trying to bring that inflation under control, and it's almost it's having a detrimental effect in other areas, as you say there, Chris. So really interesting stuff. I mean, I think probably the other big challenge that's been screaming at us over the last maybe 6-12 months, if not a little bit longer, is kind of the labour disruption that we've seen over sectors as well. I mean, Nicola, you've recently written a blog for us on this very topic. Do you think this is something that's going to be a little bit of a flash in the pan while everybody strikes, or do you think this is something we're going to see continue for months, if not, years to come?
Right, I think it's interesting you say I'd definitely have a flash in the pan. I think in terms of, you've already mentioned, we've seen it for certainly the past 6 to 12 months accelerating. The first kind of resurgence of the strike action that we saw was probably back in autumn of 21, when, if you remember, all of the fuel pumps were running out of petrol because of the haulier driver shortages. So it's almost been gathering pace since then, and certainly as the pressures have intensified in terms of the inflation that we're seeing coming through, we've seen more and more of these strikes occurring. It's obviously started with some very high profile headlines for the haulage sector, but it's transitioned across certainly the rail and bus networks within the transport sector itself. But even beyond that, in terms of kind of postal workers, civil servants, we've seen doctors and nurses on strike as well in the year to date. So a lot of pressure that's certainly spreading throughout the economy as a whole. If we look at some of the figures that the ONS has put forward for the back end of last year, in the second half of 22, they're estimating that we lost in total 2.5 million days due to strike action. So even in that short 6-month period, the impact that it's having is very substantial. And of course, the main driver for this is pay and wages at the end of the day, and the fact that real wages, after you adjust for inflation, aren't keeping pace with that inflationary pressure that's coming through, for all of the reasons that Chris has already touched on. In fact, the latest figures to April from the ONS showed that the year-on-year real pay, in terms of total pay after you adjust for inflation, was down 2% year-on-year. So wages in real terms are still contracting. So for as long as that trend continues, we're likely to continue to see this friction and the pressure that's prompting the strike actions to take place. Employers then, I suppose, have a bit of a trade-off as to which route they take, because you either commit to paying your employers more and sacrifice that additional cost and a little bit of your margins, or you risk the disruption that's being pushed through by industrial groups at the moment, which in turn carries its own cost and has an impact on your own day-to-day operations. Chris has already alluded to the fact that some of the inflationary measures are still showing persistent inflation, certainly at the core level, even if you strip out the record energy inflation that we've seen in recent years. So based on current rates of inflation and current rates of real wages, I suspect we could probably see this ongoing, certainly this year, if not into next year as well. Most recently, we've seen some of the headline strike groups who are pushing through repeat strikes, and by that I mean they've already striked in 2020 and achieved pay deals, and they're now looking to do the same again in 2023 and potentially extending that into the beginning of next year as well. So unfortunately, for as long as we've got this pressure, certainly the labour disputes aren't going to go anywhere anytime soon.
Thanks, Nicola. So last question from me, just thinking about the time, I want to get in a couple of questions from the chat from our audience. We'll just go back to interest rates. They've been quite lively, I think it's fair to say, over the last couple of months. Can you just give me a feel for, the businesses that you're dealing with? How are they coping with the cost of borrowing at the moment, do you think, given the interest rates?
Yeah, I mean, I think there's a chart we could flip up here for you this morning that probably indicates what we've seen over the past decade or so. And a former Bank of England governor have said we've been living in a fool's paradise of ultra low interest rates for a while now. 6% was considered to be the norm before we had the global financial crisis. we have lived in a very, very low interest rate environment for a long time now, and I guess something had to give. But in terms of communication with buyers, there are two fundamental questions that we address when we communicate now. And the first thing is, if you've got a debt facility, is that interest rate fixed? And this is akin to anyone who has a mortgage as well. You know, if you've got a facility with a fixed rate of interest, the first question is, okay, it's fixed, you know where you are. The second then is, well, when is the maturity of that facility? Because while you may know what your interest rate is now, going forward, you know there's a bigger burden coming down the line as you exit that deal. And the willingness of a provider to grant you a new facility, particularly if you're in a sector that some may deem not so desirable. I mean, we talk a lot at Atradius, and I'm sure we have on many webinars about the construction sector and how difficult the challenges are there. You know, I think that will be a big issue going forward. Ultimately, I think it comes down to a lot of directors now are planning for the future. If they have time to build that interest rate like into their forecast, they're trying to pass it on when they can. You know, it's going to hover around this mark now for some time, we believe, and until we grapple with inflation, until we get all the economic issues that we face in the UK under control, I think that interest rate is going to be a burden for not only businesses but consumers also. And you know, and that's something that you can address in a number of ways, but there are not many factors that can mitigate against, you know, an interest rate that's gone from, on say, an invoice discount facility of 2.75% to near enough 7 now. Yeah, it's a big increase. So it's certainly on a lot of directors' minds. I think a lot of them are already pricing that into their revenue lines going forward. And again, I was actually with a business a couple of weeks ago where this is very topical for them, because they're on a very good deal that is maturing within weeks. You know, and it's a big hit to the P&L, to the profit and loss.
Brilliant. Right, thank you guys. I'm just going to take a look in the chat and see if we've got some questions here for you guys before we finish up. Right, so somebody's gone in here and just going for it. What is Atradius's current underwriting strategy in haulage, given all of the factors that we've discussed today? Go for it, Nick. Do you want to pick this one up?
Oh, I'll give it a go. I think in very brief, cautious, for, as we say, for all of the reasons that we've outlined in the call so far. Although on a slightly more optimistic note, I'd start by saying that although we're looking at the strains that are coming up, if you look at the performance of haulage businesses over the last 2 to 3 years, they actually seen a really strong performance throughout the pandemic, because a lot of us were online ordering. There's a lot of demand on that side in terms of top line growth that we saw come through. The profits that those businesses have built up, certainly throughout 2020 and 2021, do provide a decent cushion for them heading into the tougher headwinds that we're looking at the moment. That said, obviously times are changing, and there's a lot of pressures that are culminating. Chris has just outlined the interest rate pressures, which are very prevalent for haulage firms, particularly because a lot of their vehicles and their fleet is financed, so there'll be links to growing debt servicing costs. In addition to the labour issues that we've talked about as well, obviously all of that's adding into additional costs as well. There are certain subsets within the haulage sector that we're more cautious of or more concerned about at the moment. We're paying particularly close attention to the smaller businesses, typically because they tend to have less flexibility and less liquidity, which limits their ability to adapt to the changes that we're seeing come through. We're also paying close attention to anybody who's in chilled distribution or refrigerated lorries, because they have been doubly hit by both all of the pressures that we talked about already, but also the increased energy costs. It's very energy intensive in terms of keeping that chilled. So we've seen a lot of pressure on margins in that area of the industry as well. So a little bit of a mixed bag, coming out of much more comfortable times and heading into a tougher climate. So our underwriting strategy will reflect that. We are kind of tightening the grip on the industry and bringing in the regularity of our reviews as well, so that we're aware of these changes as they happen, and aware of businesses' plans to adapt to them. It's not to say that that we're overly restrictive at the moment. Ultimately, that's what credit insurance is here for. So we're here for the tougher times, and certainly still supportive of cover, but cautious in light of the areas that we've outlined.
Thanks, Nick. Right. Oh, I've got someone here who's looks like they might be a little bit concerned about their holiday in this year, referencing air travel. So I'm coming to you again, Nick. Just asking, is the sector levelling out now? And can we expect to see some more stability in the coming year? I know you touched a little bit on this earlier.
Mm-hmm. Well, stability is an odd one in the aerospace sector at the moment because of the backdrop we're coming away from. Certainly don't expect another COVID. I think certainly nothing. Nothing that severe, thankfully. So I suppose more than stability, we're probably hoping for a bit of a continued recovery in the sector. I mean, the IATA published a great range of stats that give an idea of what's happening in terms of passenger numbers. As of this year, I think, as of last year, we were up around 3 billion in terms of global passenger numbers, and that's expected to continue climbing until 2026 at around 5 billion. So there's a big growth expected in the sector over the next few years, and obviously continuing to trend in that upward direction. As of now, we're not fully recovered to the pre-COVID position, so we're still working our way back up to that base mark, but we'd expect the global industry to get there in 2024. And Europe actually is slightly ahead of the curve, so we're expected to get there at the back end of this year. The issue, I suppose, or perhaps the pitfalls that we might see, is Chris has touched on the fact that these economic pressures aren't just impacting businesses, but also the consumer. We're seeing a big change in consumer appetites in terms of people who are booking their holidays are much less likely to go for the luxury travel providers and are now favouring the budget airlines. So we might expect some restructuring within the sector, or some budget airlines perhaps performing more strongly than their counterparts who are placed elsewhere in the market. I won't reiterate the strains that we talked about in terms of oil prices, but obviously that crack spread that we referenced is coming down, so cooling slightly in terms of the operational cost pressures, banded against all of the other issues that we're seeing come through. Hopefully demand will offset the pressures that we're seeing in terms of costs increasing, and with oil prices cooling off as well, that should take some of the heat away from that industry. So cautiously optimistic on that side, but yes, expecting a continued recovery in the sector overall.
I'm not going to let you get away without the question, Chris, so I'm going to throw one at you. Nick mentioned it, just while we've got our last couple of minutes to go, Nick mentioned that aviation hasn't recovered to pre-pandemic levels. You obviously see a broad range of sectors, being engineering, would you say that's a fair statement for a lot of the sectors that we see, that we aren't seeing a recovery back to pre-pandemic levels, sorry?
Yeah, I mean, it's very much dictated by the subsector you're looking at. If I think of oil and gas in particular, with a surge in oil price, oil and gas tends to do very well. So at one point, they certainly were trading above a pre-pandemic level. But I think the whole landscape has changed for so many industries now, again, on my side of the house, and Nick touched on it, the way consumer habits have changed. The packaging sector is still very buoyant because we as consumers now opt to shop online. We all know the woes of the retail and the high street. So there are some sectors that have bounced back. There are others that have not, and in particular, niche engineering. Niche engineering is still very, very subdued, particularly into the aerospace market and particularly into automotive. Even though we've seen a bit of a pickup, it's a very difficult sector, and not anywhere near pre-pandemic. So I think it's not fair to say it's across the board. There are some green shoots out there and some glimmers of hope. Let's not be too pessimistic, but there are certainly some industries that are intrinsically linked to other factors, as I say, oil and gas, and that's boded well for them. Now, where that goes going forward, let's just see, because it has cooled off. But you know,
let's stick on the positive of the green
Stick on the
shoots
positive.
to end there. Thank you ever so much, guys, for your time, and thank you to everyone for joining us. Take care. Speak to you soon. Thanks, guys.
yeah, bye.
Bye.